Hello, everybody. Happy Thursday. Welcome to Market Minds. Back here live on the floor of the CBOE in the S&P 500 options pit. In fact, in about, what time is it right now? It's noon here. In about literally 2 hours, I'll be standing just right up above here for an appearance on Fox Business at 2 o'clock Central Time. So if you want to check that out, I'll be right back down here then. But what's the market doing today? We had a nice little turnaround here. It was really hovering around the flat line most of the day. We dipped down a little bit. Now S&Ps are on their high of the day. They're up 13 points. Maybe some optimism out of President Trump's speech that in Davos. I don't know how many of you watched that. I watched that. Got to give the guy credit. 78 years old, and he stood up there like he was 20 years old, like an Energizer bunny. I mean, he must have had his 30 Diet Cokes ahead of time. I don't think I could just keep going like he did there. But what he did and what he says are really two different things. There's a lot of what he said that I think is not just optimism, it's hopium. But we'll see. You know what? Markets like it. So that is a good thing right now. Bobby, how you doing? John, how you doing? Can everybody hear and see me okay? Excellent. Oh, it's loud. Can you guys see that? Are you guys able to see that trading going on there? Happy Friday Eve. How true. That is so good. I got to use that. I've seen that before. I've never used that. I like Happy Friday Eve. That's awesome. Okay. Hey, Paul August, I was trying to reach you in the room yesterday all day. I'm not sure if you saw it. When I get back up into the room, okay, actually, I'll just tell you right now, Paul August, you can hear me, right? Because I had sent you out your swag a few weeks ago, got returned to us because I put in the wrong address. I remember there's some 4s and 1s in there, and I kind of mixed them up. So it got sent back to us. So I resent out your swag this morning. Just want to let you know that. Okay. So there was a delay there, and that's completely on me. Okay, guys. So I didn't know what I was going to talk about today. I really didn't. So early this morning, I was in the room about 7:30 this morning and got on the mic, and there was a bunch of students in there, and I said, guys, I need some help. Any suggestions on what you want to talk about today? And we decided on, yes, beautiful butterflies. Okay. Everything you need to know about butterfly spreads. All right. So had to use a nice picture there. Maybe we'll get springtime here pretty soon and get rid of this freezing cold weather that we have. Okay. But butterfly spreads. Okay. How many of you use them? Okay. I know in the rooms when we trade them, we are typically doing a skewed butterfly, or what we call a broken wing butterfly. And I'm going to get into that on another discussion. Okay. Today is really just about the basics and concepts of butterflies. How many of you trade them? Okay. They are a very, very, I don't want to say harmless. Okay. A very low risk type of trade. Okay. Awesome. Awesome, Paul. I like that. Well, we're going to talk more about it. Okay. So, Steve, beautiful. Beautiful. Okay. Before I go into, talking about the description here, think of a dartboard. Okay. Imagine a dartboard. Putting on a butterfly spread is kind of like throwing a dart at the dartboard. Okay. Now, I don't mean to say that it's high risk because there's no calculation of expected move or the strikes you choose. Okay. But for a butterfly to pay off, you got to be in that center if you're long a butterfly. Okay. All right. So let's talk about this. A butterfly, three strikes. Okay. Three strikes, all the same expiration. Okay. Now, the key with the butterfly, we always talk about this, is that it is constructed in a 1 to 2 to 1 ratio. 1 by 2 by 1. Okay. Now, most of you probably don't know this terminology. If you do, that's great. All the guys, all the traders down here, okay, know what it is. But the outer part of your butterfly. So let's say we're talking about a call butterfly here, okay? So the low strike and the high strike, or the outside strikes, those are known as the wings. Okay. Yeah, I'm flying away here. The inside strike, that is known either as the body, or kind of trader language for that. That's the meat, because that's where the premium is. Okay. So you've got the wings on the outside, you've got the body on the inside. Okay. Now, a long butterfly, which is typically the way we trade them, okay, is where we sell that inside. So we buy one, we sell two, we buy another. Okay. Again, you can, call butterfly, put butterfly, 1 to 2 to 1 ratio. Now, why do you think it is that what would be the rationale, and why would we sell that inside strike? What are we looking for to happen there? Do you want me to turn on the other one, Mike? Okay. Okay. Why? What are we looking for? How would we determine what that inside strike is? Ha ha, Robert. Bingo, bango, bongo to the short strike, right? Where do we always want a stock to go at expiration, regardless of the type of position we have on? We want it to go to the short strike. What are we basing our short strike on? We're basing it on the expected move. Okay, Robert, you the only one in the house today? Okay, so we are targeting something specific. We're targeting that strike where ideally we want the stock to move to and be as close to that strike at expiration. Okay. So as you can see here, when we own a butterfly, or a long butterfly, maxes out. Okay. Maxes out when the stock is right at that short or middle price. Okay. The further away from that middle price, the worse it becomes for us. Okay. You could still make money in a range there, but the further away you go there, okay, whether you get down to the lower strike or up to the higher strike, once you get to either of those strikes or beyond, the butterfly becomes worthless. So we are always targeting that center strike. Out here in the SPX, these guys are trading butterflies all the time. Okay. They're not necessarily putting on, or a broker's not necessarily saying, hey, what's this butterfly? What's the market on this butterfly? But the traders are going to have a position, then they might sell an option against what they have, and they will work themselves into a butterfly. Very, very common. Okay. Very, very common. Okay. 1 to 2 to 1 ratio. And as I have on here, yes, other ratios can be used. Okay. At times we'll do a 1-3-2. Okay. Other ratios will be used, but a regular butterfly, when someone talks about a butterfly, they are referring 1 to 2 to 1. So, Ashraf, on a short butterfly, let's go back to that. And I do have an example here. Okay. A long butterfly is +1, -2, +1. Okay. That is a long butterfly. A short would be just the opposite. -1, long the middle part, owning the meat, the body, and short the wings. So if we want on a long butterfly the stock to move to the middle, if you have a short butterfly, where do you want the stock to go? Anybody? Anybody? Ashraf, Robert, anybody? Away, Robert. Yes. Well, just remember, guys. Exactly. Remember, where do we always want? No, we don't want it to go to the longs. We don't want it to go to the longs, Bill. Where do we always want a stock to go? To our short strike. So either side there as far away as possible. We don't want it to be at the longs if we're short a butterfly. Okay, we'll go through some examples. Okay, we'll go through some examples here. Always, the answer is always, guys. The always to the short strike, whether you're long a spread or short a spread. Credit, debit, doesn't matter. Ideally, short strike at expiration. Okay, so one of the most confusing parts about putting on a butterfly spread, okay, is the name of it. Okay, it's again the long and the short. Okay, if I'm long it, okay, again, I'm long the wings and I've sold the middle. Okay, selling the body, purchasing the wings. Okay, now when you are long something typically, okay, think about when you're long something typically, do you think typically that's a debit or a credit type of spread? If you own something, what are you naturally thinking? Yeah, exactly. Debit. You're thinking that you bought something, okay, which means typically you want a stock to make a big move, to get away from your long and move as far away as possible. But in the case of the long butterfly, again, we want that stock to just move enough where it gets right towards the middle. Okay. So a short butterfly, which would be a credit, okay, a short butterfly, where do we want the stock to go? As far away as possible. Now, usually, if you think about this, when we put on let's say, a credit put spread, if we sell a credit put spread, or if we sell an iron condor, we want the stock to really consolidate, right? We don't want that huge move. Here, excuse me, if you're short a butterfly, you want that big move. So it can be a little bit confusing realizing or thinking long and short versus what you want to happen. But again, bottom line is as long as you understand in your positions that you always want a stock to move to your short strike, you will always know what you want to happen to the stock. Okay, let's take a look at an example here. Okay, and I'll put my charts up here in a moment and we can do a live example as well. Okay, but let's say we have stock, XYZ, ABC, whatever it is, it's trading $50. Okay, and you don't think it's going to move. Okay. You don't think it's going to move. It's going to stay right here. So 50 is our target. Okay. So what you could do in this scenario is buy the 45. sell 2 of the 50s, because remember, even if the stock is right here, but you don't think it's going to move, that's where you want it to wind up. Okay. And then buy the 55. Okay. The cost here in this butterfly here, $1.50. Okay. Okay. Now, if we did that for $1.50, what is the most that can ever be worth? No matter what. Stock goes to 0, stock goes to 100, wherever the stock goes. What is the most this could ever be worth? Excellent. Excellent. It's no different than any other calculation, guys. It's the difference between the strikes. So if we are right at that short strike in the middle, we've got a $5 wide call spread here. If we start to move above 50, okay, that starts to decrease in value. So the maximum value of a butterfly is always going to be the width of the strikes. So in this case, and Clive, I know what your answer was, what the P&L would be, and you're right. If it can be worth 5 and we paid $1.50, your P&L would be 350. John, it's not 450. It would be 350. If we pay $1.50 and it can be worth $5. Okay, so does everybody understand that the maximum value of a regular butterfly? There you go, John. I get it. It's Thursday. As someone said, it's Friday Eve or the eve of Friday, whatever it is. So yeah, I get it. It's 5 o'clock somewhere, right? Okay. Now let's talk about potential outcomes here. Okay. Scenario number one. You hit the bullseye, right? Remember I talked about getting the dartboard out. You hit the bullseye. The stock closes right at 50. There's your P&L. Those of you that had said 350, you are absolutely right. $5 less your $1.50, you paid 350. Okay, now let's say the stock does make that move and it gets to one of the wings, okay, 45 or the 55. Bam, no bueno. Okay, the butterfly is going to be worth 0, you lose your $1.50. Now, if it closes somewhere between the wings, somewhere between 45 and 55, okay, that P&L or the value of that butterfly is going to vary. Okay, so let me ask you a question here. Where would the break evens be at expiration on this butterfly? There's going to be 2 of them. Where would the break evens be? Okay, remember we paid $1.50. Okay, there's 2 points of break evens. S&Ps are continuing its grind higher right now. But let me just tell you, there is no volume today. As busy as it has been, there's no volume today. Okay, Don says 46.50 and 53.50. Okay, 46.50 and 53.50. Okay, we've got 51 and a half, 48 and a half. Okay, Ashraf is on, Clive is on the Gilbert's on the 46.5, 53.5. Yes, those are the break evens at expiration. So think about it. If we're at 46.5, okay, the 45 call that we own is worth $1.50. The others are worthless. If we're at 53.5, the 45 call we own is worth 8.5, and the two short 50 calls are worth 3.5 each. 8.5 minus 7 is your $1.50. So anywhere in between this range at expiration, and you will make money. Okay, anywhere in that range, you will make money. With the ideal spot being at the short strike. Okay, I know this is so boring today, guys. I had Harpo up there yesterday, and honestly, I had no ideas what I was going to do, so I just put this up here for today. We'll get creative about it. Today's word of the day. Yeah, you guys probably were all thinking butterfly or ratio or something. Nah, we're going moth. Now, I'm imploring each and every one of you. You're putting, thank you, Ollie. Yes. Smash the like button right now. Just do it. Don't forget about it. Just do it right now. Boom. You could have been done with it already. Could have been done. Okay. Hit that like. Smash that like, guys. Okay. Now, let's flip over to the other side. Let's look at the short side of this. If we sell a butterfly, okay. Again, all it is the opposite of what we just went through on the buy side. Okay. So I'm going to change the color of my drawing tool here. Okay, so instead of +1, -2, +1, now we are -1, +2, -1. So that is selling the lower strike call, buying the two middle strikes, selling the out of the money call, the wings there. Whoa, what did I just do? Holy schmacks. There we go. Okay. Okay, so how do we make money on this one? We want that movement. We want the stock to move big time away from the long strikes. Our long strikes are always taboo. Move away from our longs and move to the shorts. Okay. Now, just like in any other credit spread that we do, typically, not going to say 100% of the time, but our profit on that, it's the net credit we received. So let's say in the same scenario here, we sold this for $1.50. That's the most we could make. Okay. The most we could lose is the flip side. It would be that $5 maximum value that it could be worth, less the $1.50, so we could lose $3.50.
I'll be 21.70 bids.
Okay.
1, 2, 3, 4, 5.
Does everybody get that?
Watts. 5 into 3.
Does everybody get that? When I look up here, by the way, guys, when you see my eyes going up to the, up here, I'm just looking at the big board and I'm looking at all of the trades that are coming through live. Do we ever sell butterflies, Clive? I don't. I don't think it's worth it. Okay. Yes. Just like any other position, the probability of that trade working is very high if you're a seller of that, but your payout is very small. So it's kind of the scenario where you're going to win, you're going to win, you're going to win, you're going to win, and then that one time you lose is going to wipe out all of your gains. So you can sell them. I really don't. Okay. Here's Moth again here for a second. Let's go and look at a live example. Okay. Let's look at a live example. Uh-oh. Mike, I think we disconnected. Let me connect back up here. Hang on, guys. There we go. Sorry. Let me get my charts up here. There we go. All right. Let's do this in, I don't know. Let's pick Apple. Okay, we'll keep it easy. Keep it easy. And I want to point something out to everybody here. Okay. Let's look at a butterfly that expires tomorrow, a butterfly that expires in 2 weeks, and a butterfly that expires in, let's say, 2 months, all with the same strikes. Okay, so stock right now is 223 and change. Let's look at the 220. We're going to do the same thing for all of them. 220, 225, 230. Okay. Right now, with 1 day to expiration, that thing's trading like $2.50. Okay. I'm not paying $2.50 for that. 1-to-1 reward to risk on that. So before I go into the examples of this same butterfly 2 weeks from now, 2 months from now, what do you maybe think about what happens to a butterfly as you get closer to expiration? Hey, Peg, how are you? Everything good? Always, always. Sorry, guys. What happens to a butterfly the closer you get to expiration? It's at Ashraf. That's awesome. Same thing as any other position, right? That theta, that theta starts to really set in. So it costs more on a long butterfly because you're not getting as much premium for the options that we're selling there. Now, let's change this to 2 weeks from now. Feb 7. Okay, pretty significant difference, right? Really significant difference. If I go out just 2 weeks, that thing goes from $2.50 down to what is it, 65 cents? And why is that? That reward to risk is way better, right? That reward to risk here is 435. Whoops, let me change this back to yellow. That reward to risk is 435 over 65. Okay. Or about 6.5 to 1. Right? 6.5 to 1. Why am I getting such great reward to risk on that? Typically when we put a position on, we look for 2.5, 3 to 1, something like that. Why is this so good? Why is someone laying the odds, giving me those odds on this position? Nope, has nothing to do with earnings, Nancy. I know Apple does have earnings, but it has nothing to do. Okay, what happens, guys? What happens? You go to the horse races. Okay. What's the difference between betting on a horse that's giving you 40 to 1 odds and betting on a horse that's giving you 3 to 2 odds? Okay. Don't think too much about it. Don't think too much about it. What's the difference between those two horses? Bingo. Don's got it. Probabilities. Clive, perfect. Probability. Probability. If someone's giving me 6.5 to 1 reward to risk on this, that means the probability of this working for me is not real big. Paul's got it. Pat, nice. Okay, now let's do one more because I just want you to see it live in action here. Let's change this to April. That being said, I can make this. Okay. What do you see here? It's trading for even less. So one of the characteristics of butterflies are the further you go out in time, the better reward to risk you're going to get, or the lower, okay, the lower you're going to pay. And that's because the probability of it working out is lower. It's all about probabilities and odds, guys. Okay. Does that make sense to everybody? Everybody, does that make sense? Because you know what time of the day it is? It is wheel time. It is wheel time. Boy, there is so much chatter going on here right now, but none of it is trading. Everybody is just kind of wrapped up in their own conversations here. Okay, here we go, guys. Everyone ready? Here we go. Give it a whirl. Yeah, what's that? Oh my God. The winner today, is it going to be Herbert or Chris or Robert? Oh, here we go, Robert. Okay. Okay. Robert, last time you went on a run of having like what, five in a row, or like 4 out of 6 days or something. Robert, you still here? And I think that Robert probably has every piece of swag that we have in our inventory. So, Robert, I'm just going to ask you to be patient because we have some new swag coming in, which will probably be delivered to me in about a week. And we'll send out some new swag, the Roberts rules. Yes, we did. So, you know what? We're going to spin for someone else today also. Okay, Robert. So, you are going to be on the waiting list. As soon as our new swag comes in, you are getting it. But still, send me an email, Robert, to remind me. Okay. Probability are lower farther out due to what? Type premium and vol. John just asked. Well, would I be more certain, John, with anything, okay, of an event happening tomorrow or an event happening 3 months from now? Where would I have a higher certainty of something happening? Do I have a better certainty of predicting what the weather is going to be like tomorrow or 3 weeks from now, 3 months from now? Yeah, exactly. Just think of that analogy. Exactly right. Okay, let's give the wheel one more whirl here. Here we go. Here we go. Here we go. All right. Ashraf, Tom, Paul. Tom, are you in the house? Tom, are you still with us today? Yes, he is. All righty. Bingo. You know what to do. Shoot me an email. Everybody, thank you. I will not be doing Market Minds tomorrow, but you will get the combo of Mike Shore and Charlie Moon, just like you had last week. All right. AXP, Pat. Okay, so Pat, let me ask you something because you and I both agreed this morning that it looked like AXP was going to be bullish, right? Would you do a regular butterfly where it's really pin the tail on the donkey, hit the dartboard, hit the bullseye, or a version of a butterfly, which we do all the time, a broken wing? Still the same ratio, but then it gives us a little skew that we don't have to be as perfect. So what would you think? Because Pat, you and I were both on the same page this morning. You would do a regular butterfly. Okay. Less risk, cost you less possibility of your payout. I would probably look to do a broken wing for the right reward to risk, but we'll look at it. Okay. When I get back up to the office, we'll look at it. All right. Thanks, everybody. As always, I appreciate you guys.